Hi there, Stan, the Annuity Man, America's Annuity Agent. Wasn't that some great rock and roll music? I was like bopping around. Welcome to Annuity Man Live. This is great. Get your questions ready. Today we're going to talk about what annuity is best for you, which type. Maybe the answer is none, and that's okay. But let's first go through a couple of things about annuities and some misconceptions and things like that. When people say that they hate all annuities, that's like saying you hate all trucks or you hate. But what I would encourage you to do is go to my site. What we want to do today is teach you, is an annuity right for you? I use two questions that are very basic. And those two questions are, what do you want the money to contractually do? And then when do you want those contractual guarantees to start? The reason I say contractual so heavily and put emphasis on that is because annuities are contracts. You buy them for the contractual guarantees, what they will do, not what they might do. And I also have an easy to understand acronym called PIL. P stands for principal protection. I stands for income for life. L stands for legacy. And the other L is for long-term care, confinement care. And if you don't have to contractually solve for one or more of those items in the PIL, then you do not need an annuity of any type. It's really that simple. Let's go to the site real quick. Let's just run through some things I want to show you. First, let's go to the live miga feed. Migas are the annuity industry's version of a CD. There's a C Live Rates version on it. If you go back to let me just tell my team, go back to the home page, and on the home page you're going to see C Live Rates. So if you click that, it's going to take you to the page, and so because my fixed rate annuities are issued and approved at the state level, you have to put in your state of residence. So just Alabama in this case, and then we're just going to choose 3 years. You can choose any year and hit C rates. And what we do is we have this calculator shows all the best contractually guaranteed yields for the state of Alabama. And so if you see the right, you see 2.35 for 3 years. This is a MIGA. This is a CD type annuity. No moving parts, no annual fees, no market attachments. Team, go back and go to change state and year. So you want to go back to and see a different duration. So you hit the change state and go back and put in 5 years. And let's see what a 5 year in Alabama. And again, just choose your state. All right. This is the way to do that. And once again, get those questions ready. After we go through a couple things here, I'm going to just start taking questions. So this shows you how to work the live MIGA feed. Remember that annuity products are commodities. There's not an annuity that's better than another or company that's better than the other. People always ask me all the time, hey, Stan, the Annuity Man, which is the best annuity for me? And I'm like, hey, the one that provides the highest contractual guarantee for your specific situation. After you answer those two questions, what do you want the money to contractually do? And when do you want those contractual guarantees to start? Let's do one more thing and then we'll get to the questions. Let's go to the calculator and let's say run an immediate annuity quote. Now, you can run immediate annuity quotes, QLACs, DIAs, income riders, but we're just going to run an immediate annuity quote. This is a 24/7, 365. No one's going to bug you, call you, and mess with you. You just get to pull up the immediate annuity if that's running, and it is running. So we're going to scroll down and just put in, team, just go in and put in names. And so you put in your name and you put in your email address. By the way, all this information that's put into our site, we do not share, we do not sell, we do not give it away. It is confidential, period. We do not share any of that stuff. So put it in with confidence, state of resident, date of birth, etc. And you can run joint life, single life, whatever, IRA, non-IRA, Roth IRA, and you can do two types of quotes here. You can say, hey, here's a lump sum. This is what I want it to. Let's see what this lump sum will create. Or I want to solve for, let's do a reverse engineer quote, team. I want to solve for $1,000 a month. And so you can put in $1,000 a month, hit the quote. You're going to see an immediate, no pun intended, an immediate pop-up of the best quotes for your specific situation. And it's going to list the companies, and list how much money it will take. And I always tell people with annuities, a good strategy is to use as little amount of money as humanly possible to solve for the contractual goal. So you can do a joint life, you can do it in an IRA, Roth IRA, non-IRA. So just to give you I'm trying to encourage you to go to my site. We have developed theannuityman.com, so it's user-friendly. You can use the calculators. You can book a call with me. You can get my books. You can run calculators, etc. But let's get to the questions, and we'll take them one at a time. So let's get rolling. There's a bunch of questions. Here's the first one. I'm a 68-year-old retired. My wife is 55 working. Is it a good idea to convert my annuity to a Roth IRA and pay the tax on conversion? And he mentioned the company, fine company, A+ rated. Um, Roth conversions is your call. If you want to pay that upfront taxes, I do know that the current administration is kind of going, is looking at maybe targeting Roth IRAs. I don't know if they're going to. I hope not. But that's really a conversation between you and your CPA. Is it a good Is it a good decision to maybe convert it to Roth? I would say maybe if they don't mess with the law. How about that? But I don't trust the people in DC. Next question. Are MIGAs FDIC insured? Good question. The answer is no. FDIC is CDs. MIGAs are state issued and they're backed by a state guarantee fund. That site is NOLHGA.com, NOLHGA.com. And each state has a specific state guarantee fund limit that backs MIGAs up to a certain point. So, no, they're not FDIC insured. And I will also tell you that you need to look at MIGAs and all annuities base your decision primarily on the claims paying ability of the carrier, because MIGAs and these state guarantee funds, the state guarantee funds, in my opinion, have never really been tested. The other thing, too, is you can't, as an agent or someone selling annuities, and of course I sell annuities, I'm Stan the Annuity Man, you can't use the state guarantee fund as part of the sales presentation. That should tell you all you need to know. Next question. What if I want to preserve some principal, but I'm not sure I will need it in 10 years when I retire? Will it be a waste to get an annuity now? One thing I want to point out here, and keep that question up, team, is that annuity, the word annuity is not all encompassing. There's many types, as you well know. And if you don't know that, get my books and I'll send you the books on all types. But if you're going to protect principal, then it really comes down to two types of annuities. The MIGAs, multi-year guarantee annuities, which is the annuities version of a CD type annuity, and then fixed indexed annuities, which are CD products as well. Both are principal protected products. Both you'll never lose a penny to the market gyrations. Both were designed to create normal CD type returns, 2 to 4%. On the indexed annuity side, they are not market products. They are not securities. They are life insurance products. So that's the answer to your question. Next question. I might buy QLAC at 72 and start payouts at 76. How is my money able to grow during the waiting period? Good questions. With qualified longevity annuity contracts, which were put on the planet in 2014 and introduced and designed by the IRS and the Department of the Treasury for use in your IRA. So if people say, well, never put an annuity inside of an IRA, I mean, this is the prime example of how wrong that is. Qualified longevity annuity contracts are future pension products, but they have no internal trackable interest rate during the deferral time period. Give you an example. Let's just say that you bought a QLAC life with a cash refund. You put $135,000 in at this point in time, at the time of this taping. That is the limitation. It's 25%, the lesser of 25% of your total IRA assets, or $135,000. In this case, let's just say you did life with cash refund, meaning that the annuity company is on the hook to pay as long as you live. And when your Learjet hits the mountain, 100% of the money goes to the listed beneficiaries. But under your scenario, you buy it at 72, you put $135,000 in, and at 75 and a half, you die. Your beneficiaries will get $135,000. Now, with that being said, annuity companies enhance the payout and increase that payout the longer that you allow them to hold on to the money. In this case, you're allowing them to hold on it for 4 years, but there's no trackable interest rate. Next question. I'm concerned that insurance companies are selling their annuity contracts to financial companies. How does that affect your safety ratings? Very good question. If you're not familiar with my podcast, Fun with Annuities, I just did a podcast with a person. We talked about, insurance companies selling away some of their holdings, and financial companies and hedge funds and private equity getting into the business. It is a little bit of a concern. And yes, I am looking at that. And with my background with Morgan Stanley, Payne Weber, Dean Witter, and UBS, I do understand kind of what's going on with the masters of the universe. The good news is that the life insurance business and life insurance companies issue annuities is very highly regulated. They're not smarter than banks. They're just more handcuffed than banks, in my opinion. And there's not a lot of shenanigans that's going to be allowed to happen. With that being said, though, we are watching some of the things that are going on where a life insurance company will sell a block of business to a third party as a reinsurance. We're looking at that. Is it a concern? The answer is no, but I want you to know that I am aware of it. I'm doing the research on it. I'm having people on my podcast to discuss it. So there'll be more podcasts on it, and there'll be more comments on that from me in the future. Next question. Can the husband own a SPIA and the wife as an annuity and the beneficiary with income she can inherit 100% when the husband dies? Uh, yes, I think I understand your question. What you can do is you can set up your immediate annuity joint with a spouse. You can have the beneficiary as it could inherit 100% of any of the unused money. But what can't happen is, let's just run the scenario. Maybe this is what you're talking about. Husband and wife joint life immediate annuity. It's going to pay as long as one of you is breathing. So that's a transfer of risk. But if you put a like joint life with cash refund, then when the second spouse dies, that lump sum goes in full, whatever's left in the account, to the listed beneficiary of the policy. That daughter, let's just say the beneficiary is a daughter, that daughter can't continue the lifetime income stream. She's going to get the lump sum, or if you set it up joint life with installment refund, she would get payments, but only until the money is fully exhausted. Okay. And with any of these questions, by the way, if you need further clarification, please go to my site at theannuityman.com, hit the book a call link at the top, set a time with me. You get me for 30 minutes. And as you're finding out here, it is just brutally factual. It's not salesy. We're going to get down to the facts of your situation. Next question. I'm 49 years old, hubby 48. We have just over $1 million so far in retirement savings. We want income for life and long-term care help at some point down the road. Don't know when and what type of annuity would be best for us. So let's talk about long-term care first of all. Long-term care is the best way to get that is a health insurance product. It's not a life insurance product. And we work with the top long-term care expert in the country. His name is Jack Lindenberg. You can contact me. I can make that introduction. If you're looking for long-term care, then he's going to be our first stop for that. You're going to go to Jack. He's going to look at all products for long-term care. If he cannot find the solution for you, then you're going to come back to me, because there is one guaranteed issue product that I can do for confinement care. But if you can qualify for long-term care, you need to get long-term care. As for income for life, that is what I do. And we're going to quote all carriers for the highest contractual guarantee for future income down the road. And let's just say, for your example, you're 49 and 48. Let's just say you want to turn on lifetime income at age 60. We're going to quote all income riders and all deferred income annuities for the highest contractual payout for your specific situation. Do schedule a call with me. I'll customize that quote for you. And I'll also give you the name and the contact information for Jack Lindenberg, so you can go and speak with him about long-term care. So it's not a one-size-fits-all solution. It's two-step, and it's in your favor that it's two-step, because you're going to be speaking with the number one expert in annuities and the number one expert in long-term care, my opinion. And you're going to get really good advice from people who's been doing it for decades. Next question. Team. If I have a long-term care rider on a joint annuity, is the rider available to both joint owners? Does the rider cost vary depending on whether the long-term care rider is single versus joint? If you bought, like for instance, an indexed annuity with what's they're calling them doublers, an enhanced benefit or confinement care rider attached to an indexed annuity, those are guaranteed issue, by the way. And in essence, what you're doing is when you get sicker, you get your money back quicker. Okay, it's nothing more than that, but it's a good. If you can't qualify for long-term care traditionally, it's really your only alternative. In a perfect world, it's a supplemental coverage. But the answer to your question is yes. If you set it up joint life with a spouse with a long-term care confinement care type rider, then yes, it's going to cover both of you, regardless of what happens. So we can talk about that. It's a little bit more detailed than that. There's less than 20 carriers that offer these confinement care riders. I would also want to get my long-term care expert involved in this to make sure that you're getting the best coverage that you can get. But the cost on a long-term care rider, your last part of the question, they're really basing that cost on the joint life income numbers. They're basing it on that primarily, meaning that two lives being covered is going to be a lesser guarantee than just one life being covered. So it's really that basic. Next question. Great questions, by the way. Keep them coming. How to move $1.2 million from a traditional IRA to a Roth and legally avoid taxes? I'm not a CPA. I'm not a tax lawyer, but I don't think that's possible. If you're going to move $1.2 million from a traditional IRA to Roth, you got to pay the piper. You got to pay the taxes in order for it to transition to a Roth, and in order for that Roth IRA to be tax-free. You're not going to be able to circumvent taxes. But with any tax question, please interact with a tax lawyer or a CPA, but I'm pretty sure about that question. Here's the next one. Since I would want a company with very strong ratings, do you think the smaller returns with those companies are still worth it? Maybe. That's a good question. Let's talk about it from a couple of angles. If you go to my site, there is something that we offer for free called Comdex rankings. If you scroll to the very bottom of it, so, team, put that up if you don't mind. Put the site up and let me show more Comdex rankings are. I think this is important because you're basing your decision on the claims paying ability of the carrier. But if you scroll all the way down to the bottom of the page, team, just scroll, and you get to the bottom. See, at the bottom right, you see Comdex rankings. So click that. And if you, let's just pull this up while we're here, okay? People need to know this is on the site. So go to the bottom and let's pull the PDF. There's a really good, fun video, of course, with me on there. But hit the PDF. We update this PDF once a month with the rankings. And what I like about Comdex, it's not perfect, by the way, but what I like about Comdex is it shows the AM Best, Standard & Poor's, Moody's, and Fitch rankings, okay? And then it has a 1 to 100 score. So this is what it's going to look like. So scrolling down, you start seeing all the carriers that you know and love, etc. But stop right there. And you see, scroll it just a little bit. Okay, AM Best, Standard & Poor's, Moody's, and Fitch. You see that. But at the right-hand side, you see 100 on down. 100's perfect, right? But when we're looking at lifetime income, okay, and you're setting up a lifetime income stream using either an income rider, a deferred income annuity, a QLAC, or an intermediate annuity, we're looking really hard at these numbers because you are transferring the risk for a lifetime income. But when we're looking at MIGAs, CD-type annuities, we're not marrying the MIGAs for a lifetime income stream. We're marrying the MIGAs for that specific duration. So you might see a B double plus company that I might sign off on. Why? Because we're only marrying them for maybe 3 years or 5 years. Okay, we're not marrying them for a lifetime income. But when it comes to lifetime income is when the Comdex rankings really come into play. But at the end of the day, understand this, it's your money. And I'm going to respect whatever decision you have about that, what carrier and rankings and ratings you feel comfortable with. Next question. What happens with an annuity if there's a divorce in the future and the annuity had been purchased with premarital assets, et cetera, et cetera? Once again, I'm not a divorce lawyer, but this is, when you're splitting up assets, whether it's stocks and bonds and real estate, with divorce, annuities fall into the same categories of splitting up assets. That's a negotiation between you and the spouse. That's a negotiation between both lawyers on both sides. I'm sorry, I don't have a good answer for that, but really you have to just negotiate whatever makes sense in that specific situation. Next question. With current rising inflation, do you sell many annuities with that taken into account? $1,000 might be a month, might seem great now, but in 20 years, not so great. You are absolutely correct. And inflation is the gorilla in the room. We all know that. Now, there will be sales pitches you hear about annuities that will say, we have an annuity that will address inflation, et cetera. That's a lie. That's fraud. That's crazy. Nobody has that. Now, can annuities increase your income with a cost of living adjustment rider or an index with an index annuity? The answer is yes. Annuity companies do have those products in place. We can quote those for you. But understand, annuity companies have the big buildings for a reason. They do not give that away. And typically, they'll lower that initial payment 20 to 30%, just as an example, as compared to the exact same annuity without that potential increase or contractual increase. So it's not, you already own the best inflation annuity on the planet. It's Social Security, because it's not an actuarial football. It's a political football. They're just going to print more money or tax to get it. But with annuity companies, you can buy COLAs. You can have index annuities that increase, but they're going to initially lower the payment. And it's typically a 6 to 9 year break even point. Here's the way that we look at inflation. This is the way that I pragmatically solve for it. You can do it 2 ways. The first way is very easy. At the time you need more income floor, let's just say your income floor is $5,000. 2 years from now, you need $5,500. Then we ran the reverse engineer quote using the SPIA calculators. We solve for $500. We use as little amount of money as humanly possible, and we fill in that gap on the income floor. The other way to approach inflation is to have income starting at a future date. As an example, you can have a QLAC using your IRA starting at age, say, 75, 80, or 85, and having income starting at a future date. Bottom line, there's no good answers to inflation with annuities, just really bad sales pitches. Next question. Is there a situation in which a secondary market annuity makes sense? Let me just explain what that is to people. Secondary market annuities are, I'll give you an example. Someone gets in a very bad car accident with a trucking company. Truck hits a car, and they go to court, and they get really injured. The person gets really injured. They sue the trucking company. There's a settlement so that the trucking company has to buy an annuity to pay that person because they've been injured. Now, what that person can do then is take that annuity, go to the secondary market, and sell a portion or all of those payments to a person. But here's kind of the issue with secondary market annuities. I'm not throwing on the bus. This is just factual. You don't own anything. You own the rights to the payments. So you don't own a policy. You own the rights to the payments that the judge hits the gavel and says, okay, you own the rights to this amount of the payment level. The problem with that is currently at the time of this taping, there are attorneys general and that's plural for attorneys generals, I guess. Attorneys general, there's a lawsuit that a lot of the beneficiaries of these secondary market annuities that's been sold off are suing to get those payments back because guess what? Like I said earlier, you don't own the annuity, you own the rights to the payments. Right now, it's a little messy. Be very, very careful out there with secondary market annuities. I'm not saying it's a reason not to look at them, but just to understand you do not own the annuity. You own the rights to the payments, and that's where the issues are starting to happen. Okay, next. What is your opinion of universal life insurance? I don't sell life insurance. I'm a big fan of life insurance. I have a ton on me, so if I die unexpectedly, my wife shows up in a Lamborghini, you know what happened. But in my opinion, okay, life insurance should be purchased for the death benefit. You should use as little amount of money as humanly possible for the highest death benefit. Now, there's a lot of sales pitches out there about tax-free income using life insurance. There's no such thing. You're getting a loan from the policy. All loans are tax-free, but all loans are not income. If you go to the bank and get a loan, that's not income. If you go to a life insurance company and buy universal life insurance and you get a loan, that's not income. So don't let people play semantics with you. What I will tell you is that there are some very good life insurance products that our long-term care expert Jack Lindenberg is using with some of our clients that will allow you to have the life insurance and long-term care type coverage. So that's kind of where it fits. But from the standpoint of just basics of life insurance, you know, it's the best return on investment you'll never see because you're dead, right? Nod your head. So buy the most death benefit you can with the least amount of money. My opinion, level term is the best thing, the best way to do that. That's what I do for myself. That doesn't mean I'm 100% correct, but I don't think life insurance should be used as an investment, and there is no such thing as tax-free income. That is a loan. So next question. I'm 47 years old. I would like to invest a lump sum amount for returns in 15 years. What would you recommend? It really comes down to, remember the two questions, what do you want the money to contractually do? And when do you want those contractual guarantees to happen? If you're 47 and you say to me, Stan, I think I want 15 years from now, and I want a lifetime income stream, then great. Then we're going to go shop all deferred income annuity carriers and all lifetime income benefit riders showing the exact to the penny contractual guarantee with income starting in 15 years. That's the way to do it. Both of those products have both limitations and benefits. I would encourage you just to schedule a call with me and let me run those quotes and send them to you. Also, I'll send you my books on the deferred income annuities and income riders as well. But, you know, if you're 47, the only way that I think it works for you in a 15-year time frame is if you're wanting to turn on a lifetime income stream. In this case, when you're 62, then we go shop all carriers for the best contractual guaranteed lifetime income. As I might have said, life insurance, lifetime income at the time you turn 62. So we're going to quote it. Remember, annuities are commodity products, so I'm going to quote all carriers for the highest contractual guaranteed lifetime income amount when you turn 62. Next question. Is there a rating cutoff for considering companies? For example, no companies are under B++. Once again, getting back to a earlier question, it really depends to me on the type of solution you're looking for. If you're looking for a lifetime income solution, so you're looking for a pension type income, which annuities are the only product on the planet that provides that, then we're most likely going to look at A-rated or better because you're marrying that company for as long as you're breathing. And if you're breathing for a long time, We need to make sure that that company's there and they can back up the claim. B double plus typically comes into play when we're looking at MIGAs, multi-year guarantee annuities, the CD, the annuity industry's version of a CD, because we're marrying that company, that CD rate, that MIGA CD rate type company. We're marrying them for 3 years or 2 years or 4 years or 5 years. At the time of this taping, I really don't encourage people to go past the 5-year time point, because that just basic yield curve analysis says that that's kind of the sweet spot. So if there's a B double plus company, and right now there is one in a lot of states on a 5-year piece of paper is 3.15. Check the MIGA feed. Some states are lower, some states are higher, but it's over 3%. But they're a B double plus company. Do I sign off on them? Yes. If the company has made it to my MIGA feed, then I've done the research and sign off on that company for that duration. So that gives you a heads up. But it really comes down, do you want lifetime income, or do you want a MIGA fixed rate for a short-term duration? If it's a short-term duration, we can go down into the B double plus, B plus. If it's lifetime income, most likely it's A or better. Okay, next question. I have twins age 10. Can I invest a lump sum amount for each 40? Is there any annuity? No. In my opinion, I would not. The question is, should I buy an annuity type for my twins who are 10 years old? First of all, congratulations on the twins. I would not do that. I think they're better off doing something in the markets like a broad-based index fund. And I'm not licensed to give that type of opinion, but you need to talk with an advisor to do that. The time that the twins would need an annuity is if they need income, a lifetime income stream down the road. But I really don't. There's specific situations that we have used annuities for younger kids, but you'd have to just set a time with me and talk to me and explain exactly the details. But 99% of the time, anybody that's that young, they do not need an annuity of any type. They need market growth. Next question. QLAC max is 135. Does that limit the income stream if you use one of those, or add another annuity type for more lifetime income? The QLAC is limiting on the premium is 20. It's the lesser of 25% of all of your IRA type assets, qualified assets, or 135,000, whichever is less. For the QLAC amount, you are limited to the 135, which limits the lifetime income stream, which, by the way, is based on your life expectancy, mortality credits, not interest rates at the time you take the payment. And just on a side note, right now, and this is not a sales pitch, mortality credits are at a pro-consumer level. They're getting ready to be moved against you just because of the whole COVID thing. I did a really good podcast on my Fun with Annuities podcast with Tom Hegna. You can go to those replays on my site and watch that. We talked about mortality credits. Right now, it's really just a good time to do that. But getting back to the question, you can create the lifetime income stream for the future. We're using the QLAC, but then we can use other products, income riders or deferred income annuities or a single premium immediate annuities, either inside of an IRA, non-IRA, Roth IRA, to make up the rest of any type of income floor that you need to put in place that complements Social Security. So yes, the QLAC does limit you from the standpoint of the premium, which I guess would then limit the amount of income that you can derive from that QLAC 135 amount. But we can also always go and look and quote other product types that you can use inside of your IRA for lifetime income. Next question. Should I start a QLAC just before 72 in consideration of the RMDs? The answer is no. People ask me this. I'm glad you asked that, Mr. Recluse. I love that. Right now at the time of this taping, required minimum distributions, the IRS taps you on the shoulder at age 72. Used to be 70 and a half. Now it's 72. That doesn't mean you need to buy a QLAC then or later or whatever. QLACs can be purchased at any time. My opinion is you should start the income 75, 80, 85. You can ladder it. You could split the 135 current at the time of this taping. That's the limitation. You could split that up and have income starting at different intervals, but there's no timing of it. Just remember this with annuity companies: the reason they have the big buildings and the reason they have the logos on the plane. The longer that you allow them to hold on to the money, the more they're going to enhance the payout on the back end. Okay, so there's no perfect timing to buying an annuity for lifetime income, whether it's a QLAC, an immediate annuity, deferred income annuity. One of the biggest mistakes I'm seeing right now is, well, I'm going to wait, Stan the Annuity Man, America's Annuity Agent, because interest rates are low. You're missing the point. Mortality credits and life expectancy tables drive the train of pricing with all lifetime income. Interest rates play a secondary role interest rates play a secondary role, and they would have to significantly move for the payment levels to go up. With that being said, just as a reminder, mortality credits at the time of this taping are a bargain in the consumer's favor. Next question. Can you set up an annuity through a charitable remainder trust? The answer is yes. You'd have to, we would work in conjunction with your tax lawyer, CPA. They would have to be the final one that would sign off on that. And the annuity part of that question is the easiest part. The hard part is putting all of those things together and making it work exactly like you wanted to work. But we do this all the time. We work with charitable remainder trust, lawyers, etc. And we do that. So what else? Next question. What about fees? Let's talk about fees. And I'm glad you brought that up. Fees with annuities, we do get paid. I mean, I sell more annuities than anyone on the planet. I'm proud of that, but we only sell them when they're suitable and appropriate. My commissions are paid from the annuity company, their reserves. So if you look at like the light bill or water bill, commissions are in that same category. They pay me from that. It's a net transaction to you, okay? But most annuities, and most people don't know this, they don't have fees. MIGAs, SPIAs, DIAs, QLACs, index annuities with no riders, they have no annual fees, period. Don't feel sorry for the annuity company. They're doing okay, but they have no annual fees. Once you attach an income rider to an index annuity, that will have an annual fee attached. Variable annuities, and nothing against them, I don't sell them, but nothing against them. They are the ones that typically have the most fees. But as an argument against that, there are such things as no load variable annuities, period. And those have no fees. Or if they have fees on the separate accounts, mutual funds, they're very teeny tiny. But the average fee on a load variable annuity is anywhere from 2 to 3%, depending on, for the life of the policy, depending on the variable annuity that you're looking at. We just don't sell anything that goes down in value, and also that has the potential to go down in value. And also, when we compare income riders to variable annuities and index annuities, typically, not all the time, but typically the index annuity income riders have a higher contractual guarantee. So those are the fees. If you want to ask me what the commissions are on, if you're buying something specific, I'll tell you. I mean, I will tell you what they are. I'm very transparent, but we do get paid as a net transaction to you. If you put $100,000 in on any annuity type, you'll see $100,000 on your statement. Next question. Can an index annuity have a guaranteed rate of return and at times get a higher return based on the market? The answer is yes. And this is a common bad sales pitch that I hear out there. With indexed annuities, let's just say you're not buying an income rider, okay? Let's just say you're buying it for accumulation. And we have a couple right now that we're recommending for accumulation. If you want to see those, I'll send them to you. But annuity companies will have what's called a guaranteed rate column. That is a separate calculation. And then they'll have the index return column. That's where the caps and the spreads and all that stuff are there. But it's two separate calculations. The reason that that's important is that guaranteed rate, and let's just say for conversation's sake, it's 1%. So there's 1% guaranteed rate in case the market goes to hell in a handbasket over that 10-year time period or 7-year time period. You're going to get a 1% return, and you can walk away limping away and saying, "No, man, that was a bad investment." But it's typically not 99% of the time. It's typically not the floor or what the market's return. No, it's a separate calculation floor, and it's just a really, really low interest rate. And typically, not all of them are 1%. They could be less than 1%, but it's that less than 1% that you're going to get if there was no market returns or no lock-ins of gains during that duration of that contract, if that makes sense. Next. Can I pass an annuity on to my kids upon my death? If so, will the payout stay the same? You can't. Well, this is a kind of a loaded question because annuity, meaning all types, we'd have to talk about all types. From the standpoint of current tax law, there's no more stretching of annuities. You can do that with your spouse, but not your kids. But could you set something up with your kids so that the payout will be the same? Yes. Let me give you an example. We've had a couple of occasions in the past where, the 80-year-old grandfather wanted to set something up with the, 5-year-old grandson, bought a joint life immediate annuity. Obviously, the payment's going to be primarily based on the younger of the two, the grandson. But in that case, that's a situation where the income would continue uninterrupted and unchanged when the 80-year-old died for that 5-year-old for the rest of their life. So yes, we can structure it so that it can continue uninterrupted and unchanged. I would have to speak with you one-on-one and find out what you're trying to achieve. I've done those before. I call them legacy income monsters because it's a pretty cool legacy play. But yes, you can pass an annuity onto your kids and have that income continue even though you're in the grave, as they say. Next question. How about a variable annuity for kids? I'm thinking of investing lump sum for kids. No, please don't. And I know that some agents will say, yeah, buy it. No, I would rather you, and again, once again, I'm not giving you investment advice because I'm not doing that. I'm a fixed annuity specialist. But put them in the market, put them in a broad-based fund, talk with an advisor, talk with a fee-only advisor, and have them put something together for the kids. You do not need a variable annuity for the kids. And the reason is variable annuities, good or bad, they have limitations on the investment choices that you can choose inside of that variable annuity. Me and you call them mutual funds. Everyone else calls them separate accounts, but they're mutual funds. And with all variable annuities, I don't care if it's load or no load, they have limitations on the choices. When your kids, and when it's involving your kids, they don't need any limitations. They need growth, and they can handle market volatility over their life expectancy. So please don't buy a variable annuity for your kids. Okay. Next question. Are you rewriting the annuity stanifesto? Interesting, Ronnie, that you brought that up. The answer is yes. I am rewriting all 7 books. I have 6 owner's manuals and the annuity stanifesto that came out in 2014. And I look much more vibrant and young on the cover. If you have that, if you want me to send you a copy, shoot me an email, stan@theannuityman.com. I'll shoot you an email of the annuity stanifesto. But yes, I am rewriting everything. That's my project for 2022. My marketing team and management team is yelling at me, hey, Stan, you need to rewrite it. So the answer, Ronnie, is yes. Of course, I'm going to rewrite it in that raw writing fashion that I have, which I call writing without the curse words. But it's going to be good. I'm going to update some things, and it's time for it to be rewritten for sure. Next question. Please expand why you're saying now is a good time because of mortality rates. I will, Richard. I appreciate you asking that. And like I said, please go back and listen to the podcast, Fun with Annuities podcast, which, by the way, comes out every Tuesday. But the one we did with Tom Hegna talking about mortality credits was good. Here's the reason, and not to be morbid, I want people to take a step back, and I apologize if this sounds bad. But with COVID, there's a lot of people who died that already had comorbidities. They had issues. They were older, etc. And a lot of those people died. And because of that, it kind of cleared out those people. And that's horrible to say. But the people left, us, right? We're a little bit more concerned about our health. We're doing better, etc. And what I'm hearing and what Tom Hegna was saying was the mortality credits, meaning that the projection of how long you live is going to be pushed out. So they're going, right now is a good time. Right now it's in your favor. It's pre-COVID. But once the dust settles here, the annuity companies, life insurance companies are supposedly, allegedly, potentially, what I've been told, going to increase the mortality tables to mean that they're going to project you to live longer, which means there's going to be more payments projected, which means those payments will be less. But it's because of COVID. It's because of the 700,000 plus people that died, most of them that had comorbidity issues that were 70, 78 or older, etc. And it really just kind of cleaned that out so that the mortality credits, they're gonna raise them and push them out. So this is a time, if you're looking for lifetime income, if you're trying to time interest rates, you're looking at the wrong lever. The lever to look at is the mortality credit lever. So hope that explained it without offending anybody. Next question. Can you talk about pros and cons of laddering versus lump sum? Sure. When you're talking about with multi-year guarantee annuities, let's look at that from the standpoint of you're getting an interest rate. These are CD type of annuities. Laddering makes sense. So let's just say you had $300,000 and you put $100,000 in a 3-year, $100,000 in a 4-year, $100,000 in a 5-year. Okay. That makes sense because we don't know where rates are going to go. And please don't say cavalierly they have to go up, because they don't. People have been saying that for 6 years. They can go down, they can go to zero, and they can go negative. But hopefully they'll go north. But if you ladder 3, 4, and 5-year durations, then you have money coming due start every year, starting year 3, hopefully to then transfer and attach to a higher interest rate. Laddering for income makes sense if you're having income start. You can do laddering 2 ways. Let's talk about the first way. Laddering with different start dates. Let's just say you bought three different types of annuities. You have one starting at age 70, one starting at 75, and one starting at age 80. That's a very, very efficient way to address potential and future inflation and have income starting and adding to your current income floor in different time intervals. The other way to do laddering is laddering the purchase date. There's a lot of people right now that they want to put in the income floor, but they don't really want to take a big lump sum of money and get out of the markets. And what I tell people is, hey, if you have $300,000 in your head and you're going to put in the income floor, let's buy $100,000 of lifetime income transfer of risk contractual guarantees now, today, $100,000 next year, $100,000 the following year. So you can ladder the purchase date, you can ladder the start date, and with MIGAs, you can ladder the duration. I think laddering in general is a good thought because you're not trying to throw the dart and hit one target. You're saying, I don't know what's going to happen, but I want to prepare for interest rates moving or future income starting at future dates. Okay. Next question. Can you ladder MIGAs over a period of time, i.e. 15 years, to provide a greater income than a SPIA? I think this is apples and oranges, looking at MIGAs and SPIAs. Because remember, with MIGAs, multi-year guarantee annuities, the annuity industry version of a CD, that's a principal protection product. We're not touching the principal. We're peeling off interest if that's the way you want to do it for income. So at the end of the durations, you still have all your money, but you've just been peeling off the interest. That's the way to do income. With immediate annuities, all lifetime income stream payments, including immediate annuities, are a combination of return of principal plus interest. Okay? So at the end of the duration, let's just say you bought a 15-year period certain SPIA. At the end of the 15 years, it's game over and there's no additional payments. I think it's an apples and oranges comparison. What I would like to talk with you about, Anthony, is what are you trying to achieve? And then maybe we can put a combination of these two products in place so you can maybe have your cake and eat it too a little bit, maybe have principal protection, and then enhance the income with an immediate annuity. Next question. Stan, what's better, a FIA, index annuity, or a MIGA? Good question. There's no good answer, just really bad sales pitches. Both were put on the planet to create CD returns. MIGAs are the purest version of a CD because there's a guaranteed interest rate for a specific period of time that you choose. You know, you saw that on the MIGA feed. Now, with indexed annuities, there's no guarantee on the upside return, and those upside returns are attached to call options. I've written a book on that. I've done videos on that. I'd encourage you to get the book and watch the videos and schedule to call with me so I can walk you through how that works. But at the end of the day, both are CD type products. The problem with index annuities is it's being sold improperly and, in my opinion, fraudulently as securities, as market type products. They are not. If you hear the words or phrases market upside with no downside or market upside with principal protection, the person selling it doesn't know what they're doing, or they do know what they're doing and they're fraudulently pitching it. Since 1995, the average rate of return on an index annuity, the last study I showed less than 4%. And then recently in Retirement Income Journal, they did a 10-year back look at index annuity returns, and it was around 3.5%. So that's okay. I mean, if you go into index annuities with a realistic return expectation of 2 to 4%, fantastic. But if you go into them thinking you're going to get 7, 9, 10, 12, then you're buying the sales pitch dream, and you're not owning the contractual realities. So, index annuities we love. We use them as standalone for accumulation for that 2 to 4% return. We also use them as an efficient and cost-effective delivery system for income riders, for income benefits in the future. But you can combine index annuities and multi-year guarantee annuities. I just had a client recently that wanted to put $400,000 in a ladder. And what we did is we did a 3-year, a 4-year, and a 5-year MIGA, okay, 100,000 apiece. And then we'd put $100,000 in a 7-year indexed annuity. So he had 3 of those 4 tranches that he knew what the contractual guarantees would be. And then we had that 7-year indexed annuity, no riders attached, no annual fees, that we're hoping that exceeds the guarantees of those 3 MIGAs. So they can be used together. I call that a mixed fixed ladder because we're using 2 types of fixed annuities that are both principal protected to create an interest and return. Next question. You guys are rocking. Let's see. I like that you guys are rocking. Are there any fixed index annuities out there that don't allow the insurance company to change the rules at their will? That's a good question, and I'm going to answer it by saying probably not. And maybe there's a carrier on here that's watching this and say, mine does. I just am not familiar with that. That if you read the specimen policies, And if you ever want to look at if you're ever looking at an index annuity and just want to read the policy, we'll send it to you. But in most cases, they leave themselves a back door to change the rules on the caps, the spreads, the participation rates, which are the levers that limit the upside. Okay. Typically, they do have the capabilities of changing those rules, but you have to remember there are some index annuities with 1-year call options, some with 2-year call options, some with 3-year call options. I think there's even some with 4-year call options, meaning that, let's just take, for example, there's one right now we like that has a 3-year call option. Okay. That means they can't change the rules for 3 years, which I think is good. And historically, the longer term options have shown better potential. But you got to remember, annuity companies have the big buildings for a reason. They're not going to create something that's not in their favor and that they can't pivot if something needs to change from the standpoint of pricing. So in my opinion, you have to go into any index annuity contract, and we'll explain all this to you, obviously, if you're wanting to do that. And the accumulation value, understanding that they can change the rules. Now, one last thing about that. My team does a great job of researching what I call renewal rates. There's companies out there that are very pro-customer with renewal rates. So when, let's just take an example, 1-year call option, and then the next year they can change the rules. There's companies out there that are very favorable to the consumer. There's some companies that are not. So we really look at the renewal rates of index annuity companies to see who has been fair over the past 10, 15 years and base our decisions not only on that, but other things as well. But renewal rates are a big thing for us. Next question. If the income floor needed minimum is $50,000 starting within the next 10 years, which is the best type of annuity? DIA right now, or wait and do an immediate annuity later? Great question. And there's no good answers, just bad sales pitches, right? So let's look at that. You need income to start in 10 to 12 years. If you want to know to the penny today what it's going to be and you want to lock that in, then we're going to quote deferred income annuities and income riders. Those are the two, what I call income later solutions that can contractually solve for that. And you can know to the penny what the income is going to be in 10 or 12 years. But the second part of your question is very important. Could you wait? And at the time of that you need income, buy an immediate annuity? The answer is yes. There's nothing wrong with that. The annuity sales gods hate that because that means we're not selling anything, but that's okay. I had a call this morning. I'm not kidding. This morning, a person, they were 49 years old. They had multiple millions of dollars in the markets and variable annuities and things like that. And I said to them, do you need income now? No. Do you need to know what the income is going to be in the future? Are you that type of planner? They're like, no. I said, well, then you need to wait. And at the time you need income, then contact me. We'll quote all immediate annuity carriers for the highest contractual guarantee at that time. I call that strategy defer to SPIA. Defer to SPIA means keep your powder dry. Don't buy an annuity, and buy an annuity at the exact time you need income. A lot of people do that, but there's a lot of people that want to make sure what that income stream will be and or lock in those mortality credits at the current level because they're in your favor. There's no perfect answer, but certainly something, Melanie, that we probably should talk about. So, schedule a call with me. Next question. With a safety first mindset, is there a certain percentage of living expenses you suggest we aim to cover with Social Security and annuities? Good question, Michael. In my opinion, what he's talking about is an income floor. What's the income floor? That's the amount of money that's going to hit your bank account every single month, regardless of who's in office, who's in Congress. It doesn't matter. It's going to hit your bank account. That could be that's going to be Social Security, the best inflation annuity on the planet, a pension if you're so fortunate, dividend income, rental income, side hustle income, whatever. My opinion is I would encourage you to solve for all of it. Okay. And the reason I say that is once that's in place, once that income floor is in place, period, you're going to be a better investor with the non-annuity assets. But understand with inflation, if inflation hits and you solve for the income floor right now, 2 or 3 years from now, you might need a little bit more. Then we do a reverse engineer quote using immediate annuities to solve for that gap in the income floor. But my opinion for everyone out there, solve for the income floor. If it's you and a spouse, you and a partner, solve for the income floor now so that there's a continuation uninterrupted and unchanged if something happens to you. Plus, I'm telling you, believe me when I say this, you will be a better investor with your non-annuity assets if that income floor is in place and you don't have to disrupt the investments to get money out if the markets go down, period. We did on a side note, we did a podcast recently with Wade Fowl on my Fun with Annuities podcast. You can go to my site and listen to that. And Wade's talking about, he likes people to have a line of credit on their house, not to use it, but just in case you need to tap into money, instead of tapping into your investments, have that as the source to tap into. And I know people are like, really? That's what he said? Yes, that's what he said. And it makes sense to look into it. I encourage you to listen to that podcast. Next question. Just wanted to say thanks to Stan for his amazing transparency. Holy, thanks, Mom. I appreciate that. I will tell you something about our company. We are brutally factual and brutally transparent, and there's really no sales pitches. I really believe this is where you go to, you go to buy annuities. You're not going to be sold. I mean, do I sell them? Yes. Do I sell more than everybody? Yes. I'm proud of that. I'm licensed in all 50 states. Proud to call myself America's annuity agent. But you'll find that the buying process with us is really cool, and it's laid back, and it's on your terms and on your time frame. Remember that there's no urgency to buy an annuity. The urgency is to understand what you're buying, period. Get your arms around it. Any other questions? Because I'd like to go through the application process and how that works. What do you think, team? Should we go there? Let's do that. So let's go quickly to, and please hang in there with me. Hang in there with me. This is important because people always say, well, how does the annuity buying process work? So if you go to my site and you go to the About dropdown, so they'll show the About customer journey. Okay, we've done it two ways. First of all, I have the best team in the country. They're great. You can watch the video. It's an animated video without me, which is cool. And that's about, I think it's 3 or 4 minutes long. You can watch that. But let's scroll down. Underneath this, it shows how all the steps of the process. The bottom line is this. If we'd have to talk one-on-one. You have to set a time with me and we talk. Once we determine the annuity is suitable and appropriate for you, I'm going to schedule a time with my team. And they're going to call you right on the dot. They're going to ask you all the questions, non-shared, confidential, period. They're going to fill out the form for you. They're going to send it to you either hard copy or encrypted via an email website link, and that's the way it happens. And then we take care of all of the minutia internally and keep you updated via email and during the process. If it's an IRA to IRA transfer, we make sure that's a non-taxable event. If it's an annuity to annuity transfer, non-qualified, let's just say, that's a 1035 transfer, we make sure that's a non-taxable event. If you're writing a check to the annuity company made payable to the annuity company, we facilitate the pickup of that and pay for that delivery to the annuity company. And then at the end of the process, the policies are typically delivered to me. I review them for accuracy and then send them to you and understand, and we overnight them too, and understand that annuities, we're the only product on the planet that allows a free look time period, meaning that you can get your money back and you don't have to provide any reason why, which is great. So things might have changed and you just want to get your money back. But here's what I encourage you to do. I'm glad you joined us. Do this. Go to my site, theannuityman.com. Pull that up one more time. And let's just run that quickly. And then we will exit out of here and I'll have a good rest of the day. If you go to my site, theannuityman.com, on the homepage, it really kind of revolves around the homepage. At the top, you see the book a call. You can book a call with me. 99.9% of the time, you're going to get me. Use the calculators. You can go there, run your own quotes, real-time, 24/7, 365. It's fantastic. You can go to the MIGA Life, see live rates. You can go to the MIGA feed and see that. You can get my books. We'll ship them to you for free and under no obligation. And if you scroll down here, team, you can see we list the top videos. We list the top blogs and articles, the top podcast. We are educating out here. I'm trying to do it in an edutaining format, hopefully. But hey, with that, let me just tell you something. I really appreciate you spending your time today with me on Annuity Man Live. We're going to do this every quarter at a minimum. So we'll give you those updates and let you know when the next one's happening. And I'll see you next time. Thanks for joining us.